one form or another, we're going to see a lot more, transactions, and we are already seeing it in our firm.
Hello, everyone, and welcome to The Landscape, George Smith Partners podcast. I'm joined here by my lovely co-host, Mr. David Pascal.
Hello.
And our third co-host today, Mr. Ed Stefflin, joining us from New York. Today, we have a very special guest. It's Mr. Jonathan Roth of 3650 REIT. We'll let Jonathan introduce himself here in a moment. Before we do that, we'd just like to tell you really quickly where to find us online, or how to learn more about us on the podcast. If you're finding this the first time, go to www.gspartners.com and you can sign up for FinFacts, our newsletter there. And then with that newsletter, you'll receive the podcast. You can also find this on Spotify, Apple Podcasts, YouTube, and most of these podcast sites. So without further ado, let's let Jonathan here
introduce yourself.
Yeah, let's rock and roll.
Hello, everybody, and thank you, gentlemen. I've known David for decades. I've never heard him described as lovely. Nice. So the lovely David Pascal. Thank you, guys, and I really appreciate being here. My name's Jonathan Roth. I am a co-founder with my two partners, Justin Kennedy and Toby Cobb. Our firm is called 3650 REIT. We're a national footprint, fully integrated real estate investment firm. While we do some equity investment out of our development side, we are really a lender. And when we created our company and launched in 2018, we wanted to have products that really fit every moment in time of a particular real estate project. So we have various strategies, lending strategies. On one end of the spectrum, we call it the bridge and event driven. The acronym we use is BED. And that is designed to lend against assets that are in some stage of transition. And it can be ground up construction to acquisition and repositioning financing, partnership recapitalizations, all the way into the realm of distress. If an asset ends up in bankruptcy, we can do debtor in possession. When we do construction lending, we generally do the whole, 0 to 70, 75, 80% in the cap stack. We do not use leverage, and that's a distinguishing factor that you'll hear us talk about. When a debt fund uses leverage, that means there's somebody else in the room that's making decisions about the underlying asset. And particularly when it relates to construction lending, you really don't want to have too many opportunities for other people to raise their voices. So we've always found that having a pure play, stretch senior is a very compelling opportunity, not only for us, but also for our borrowers. In the bridge and event driven strategy, we also do mezzanine and preferred equity. We do a fair amount in the multifamily space behind agency financing. Our other sort of bookend strategy is what we call SCF, or stable cash flow lending. That is where we provide 5 and 10-year fixed rate loans. In 2023, which was a year that had very low volumes, I think we ended up doing 3 securitizations for a total of about $2.3 billion. The vast majority of those were 5-year executions versus sort of the normal way 10-year. I think that's going to switch, and we'll probably talk about that a little later. We have a transitional lending strategy, which is sort of the poster child for that is a multifamily asset coming off a construction loan that's maybe 30, 40, 50% leased up. It's not ready to sell. It's not ready to permanently finance. So we have a strategy for that. We also have a special situations fund that is designed to capture opportunities to buy existing indebtedness, that has kind of a heavy lift to it. We can end up owning the underlying asset, or we can just do a lot of modifications and restructurings and work with the borrowers. Our goal when we created the firm was really to have a source of capital for best-in-class borrowers that have best-in-class assets, and candidly have a source of capital so they wouldn't leave our ecosystem. We also believe very strongly that we should originate our own loans, do our own due diligence, structure and hold the loan on our balance sheet for the life, and most importantly, service the loan. And in fact, that's why our firm is called 3650. So for 3,000 up to 3,650 days, where we service your loan, we're your relationship. And I would say today our servicing portfolio is just about 17 billion, and these are all loans that are on our balance sheet. And I'm delighted to say, and I say this reluctantly and a little bit hesitantly because it could change, as soon as we hang up here. But we have zero loans in default or loans that are delinquent. And we attribute that track record to the fact that we really place a premium and a high importance on having a direct relationship with our borrowers and being able to attend to issues and situations in a very timely manner. And my cell phone's on my business card. Yep. It's as is everybody else's cell phone on their business cards within 3650. We really genuinely believe that if you handle a problem early in its gestation period, there are a lot more solutions to that problem than if you wait and let it fester. So we believe hands-on loan servicing, direct relationship produces better outcomes. And so I would say that's kind of 3650 in a nutshell. We have 7 offices across the country, nearly 70 plus employees, and we are looking forward to, 2023 was a year of, it was interesting, originations and transactions fell off a cliff, as you well know. We think 2024 is going to be a transitional year, and we're delighted that we have the capital and the bandwidth to be able to look forward. We're not burdened by legacy issues, so I'm kind of excited about the opportunity set.
So David and Ed here, should we start first with peppering Jonathan a few prognostications?
Yeah, let's do that. You kind of segued there. Any 2024 macroeconomic predictions, such as how many Fed rate cuts? Are people interested in that? And any predictions on the directions of Treasury and yield curve inversion, and will we have a recession?
All the easy ones, right?
Yeah.
Oh, just those. Okay. Look, I'm not in the business of making predictions, but I will tell you, we've had a 150 basis point, or 130 basis point rally in the risk-free rate. We've had spreads tightening, and I think that's going to continue. I don't know, the date upon which the Fed will start, to lower rates, but it's definitely going in that direction. The market has already baked that in. Has the market been overly aggressive? Maybe. But I have either the good fortune or the curse of spending a lot of time on airplanes, and I spend a lot of time in most major cities in our country, and I will tell you, I don't see things slowing down. There's a lot of economic activity in certain areas. In other areas, and cities like San Francisco, it's pretty quiet, and there are issues there we'll probably talk about. But I don't see the economy coming to a screeching halt. Will we go into a technical recession? Yeah, probably. At some point, third quarter. I think information. There's a lag to information, but I don't see us falling off a cliff. Having said that, it would be irresponsible not to caveat everything with we've got some pretty big macro geopolitical issues with what's going on in Israel, in the Middle East. Every day there's new headlines, and that conflict is spreading. It's not contracting, and I don't want to underestimate the impact of that globally. But I think in general, if barring any material exogenous event, we will slow down in our country. We won't fall off a cliff, and I think transaction volume will increase because as investors, there was a lot of capital raised, and there was very little deployed last year.
Right.
And, investors want to put capital to work. And I think, last year what we saw is if you didn't have to transact, and I'm sure you all saw this as well as we did.
Yes, we did.
Yeah. If you didn't have to transact, you weren't going to. Now,
That's right.
we have 2 trillion of maturities that are, this year, the next year, the year after that. You're going to have to transact. And there's going to be, capitulation with buyers and sellers. There's going to be, restructurings done. And those restructurings will facilitate, a variety of different outcomes. Some will be, there's a pref equity provider that will, that will provide capital so that the normal way senior financing. There will be a sale of an asset just to get it off somebody's balance sheet. And so I do believe that in one form or another, we're going to see a lot more, transactions. And we are already seeing it in our firm in terms of the inbound inquiries for
interesting
across the board, candidly.
Ed, I want to ask some follow-ups, but maybe do you have any prognostications here, or you want to try to dodge that bullet?
Or do you have questions for Jonathan?
No, I mean, I think the Fed, just going back to Pascal's original question here, I do think we'll see some Fed rate cuts. I think that will happen. I think the industry's positioned itself for some distress, which may or may not happen in magnitudes. We're not sure. So it'll be interesting to see how it unfolds. And, I think the regional banks stay fairly weak, which obviously for you, Jonathan, is a great, right? I mean, I don't see the impetus for a mass increase in deposits at regional banks. I hope I'm wrong, because they obviously do a lot of lending for our clients, but I don't see that impetus.
Yeah, I mean, look, Ed, you raise a really important point. Regional banks make up 40 to 45% of all real estate lending in our country. Think about that statistic. And you have a couple $1 trillion of loans that are coming due. That's a big chunk is held by those banks. And while the Fed has been guiding banks to work with borrowers, there's only so much one can do. And across the board, just because the way rates have gone, you've had value degradation, anywhere from 15 to 30 to 40% in a normal way asset. Forget the conversation around, other troubled asset classes, namely office. And so those regional banks and their absence obviously creates opportunities for, firms like 3650. But it also is going to create, there's a lot of, everything is, private credit. Yeah, it's big and it's getting bigger, but it's not going to fill the entire void that's created by the absence of the banks.
Yep. Interesting.
I have a couple follow-up questions. So, you ran through, I think, all the different products that 3650 has to offer. And obviously, I think, well, maybe not obviously, you're one of the more active folks in the CMBS world last year, as you mentioned. What, for 3650 this year, 2024, and kind of like you said, a transitional year into 2025, are you guys focused more on trying to put out special situations funds? And let's talk about that. If so, what does that look like? You mentioned also, equity recaps. I think you also said even, partnership level recaps. So let's talk about that, what that means, and with respect to capitulation, because what we've noticed here on our end, we're in a little bit different part of the market than you, right? So folks come to us and they say, hey guys, what's out there in the world? And we're constantly in communication with, hundreds of groups like 3650 and also hundreds of clients. And so we have a pretty interesting purview into the market. And one thing we've talked about here internally a lot is that we've started to see, at least on the client side, a more capitulative demeanor.
Yeah, they're accepting.
Yeah,
more than they were in late 2022 and early 2023.
They're recognizing that this is just not going to just go away super quickly. But then I think sometimes when they come to us, like Ed and I had a great call with a client yesterday. Fantastic firm, great track record. bought an asset in a market that was real hot, institutional asset, maybe 300 to 400 units multi, and bought the asset. Rents didn't appreciate in the way they expected. They're on a fixed rate loan, but from a non-bank, non-agency lender, and they have a looming payoff and or extension with difficult hurdles that they're impossible for them to get through those extensions without modification. So this is kind of a loaded, like, multifaceted question, because you have capitulation on both ends. Like, will the existing lender want to extend? Do they need payoffs because they have fires in other areas where they need capital? Like, give us a little bit of a sense of how 3650 is positioning itself. What are you guys looking for, and how do you expect to deploy in this capitulative environment?
So, look, at the end of the day, we make one loan at a time. So we're gonna look at an asset, we're gonna look at value, and we're gonna size a loan. And if the borrower or the owner is looking for a 5 or 10-year fixed rate loan, or if it's a construction loan, it's one asset at a time. We've always done very well by not, what's the expression, throwing the baby out with the bathwater. And so, when retail was in a death spiral, not all retail was bad. We learned during the pandemic that grocery anchored retail was best in class. Not all office is bad. Office loans, we're right now in the middle of closing a construction loan for almost a purely spec office building, and we have a history of doing that. And so we're not, we get very granular on an asset by asset basis. So what are we looking to do? We are looking to continue to deploy capital in our fixed rate program. And I will tell you that a lot of our competitors are not necessarily sidelined, but there's a lot of movement in our industry. Firms are downsizing. When productions fell off a cliff last year, it gave firms an opportunity to shed some staff. So we're seeing a lot more volume in our fixed rate business, and I think that's driven in large part by what I said earlier. It's if you didn't have to transact, you didn't. Now that your loan, you have a looming maturity, or you have extension rights that you won't meet, and you have a lender that's really not taking your phone call. We're seeing a lot of folks that are finally saying, okay, rates have come down. I can do a 5-year execution at a relatively, what the benefit of, at least, David and Ed, I don't know how old Ed is, but I've known David for a long time. We've been doing this for a long time, and it's shocking to me. It was shocking to me that when rates had a 2 handle or even a 3 handle, that borrowers chose floating rate, floaters versus fixed. It's like, if you can't make an asset work with a 3 handle on your debt, then something's wrong. You're buying it at the right price. Something's wrong. So in today's world, the more seasoned investor, owner, operator is realizing that if you can get debt in 4, 5, 6% range, you should take it and lock it in and ride out what will likely be a volatile environment over the next handful of years. And so we're seeing that borrowers have, a lot of folks in our industry made a lot of money over the past decade. And so you mentioned a minute ago, capitulation, cash in refinancings. We're seeing borrowers that are willing to do that because they have an asset that they like, that they want to hold on to. They don't want to deal with the noise of, giving an asset back or something, more controversial, fighting a lender. That we're not seeing a lot of that right now. We're seeing borrowers that recognize reality and they're dealing with it, which is refreshing. And that, I think that's just part of the evolution of real estate, ownership and finance, candidly. But so, for example, the end of last year, we closed 2 construction loans. One was a $90 million construction loan on a ground up development of an industrial building. here in California, 40%, pre-leased. But that transaction would never have gotten done by a debt fund. It would 100% have been done by a local bank, but no bank to be found. It's industrial infill location. And then similarly, we closed a $47 million loan on ground up construction of a 96% grocery pre-leased grocery anchored retail center here in Southern California. Again, the fact that we got the opportunity to do that is a real commentary on where the banks have gone.
Exactly. Yeah, exactly. The shadow banking system. Yeah. Let me ask a question on office. Like, define good office these days. We hear that it's highly amenitized. Suburban office is back sometimes because people want to live near and come back and forth to the office and not have a big drive downtown. What are you seeing on what's the we hear also, maybe we'll correct this, sorry, but also we've seen that tenants are flocking to, not surprisingly, office buildings built within the last 5 years, the best stuff. So what's your look on that? And that could also go into certain cities or regions for office.
Yeah, so look, as I said a minute ago, not all office is bad.
Right.
So we start with that premise. I think it was a tragedy beyond tragedies that we are governed by folks at the federal level that only a couple, 3 months ago told the federal agencies to get their workers back to the office. I just think it's
DC, yeah.
It's just that it's outrageous to me. I think that contributed to the problem. In our industry, work from home is not it's not really prevalent, because with real estate, you have to be there, you have to show up, you have to touch it, you have to feel it, you have to be at other industries that may work very well. It just doesn't work that well for our industry. So, we've all been back in the office. And so what we're observing is that Class A is still where people want to be. New, 100%. And what new means is, you've got higher ceilings, you've got, operable windows, you've got open air, you're highly amenitized, you're well located, and you've just got that cool new factor. And it's really quite interesting. In our development arm, we delivered a new office we're headquartered in Coconut Grove, which is a suburb of Miami. And we redeveloped a project called Coco Walk, which was a early 80s, I believe, built multi-story open air retail center that really just fell in, disrepair. It was out of date. And a handful of years ago, we redeveloped it. We scraped half of the retail, reconfigured the remaining retail to be more modern day, capable of more modern retail uses. And then we built an office tower on the other half. It leased up immediately. And if we could empty the building today, we could double our NOI. And it wouldn't take very long. You can't do that, but if we could, that's what would result. And so, well located, it's walkable, it's livable, and that is what is attracting. I think it's the large floor plates in central business districts. Those are the ones that are challenged, and
they're going to hurt. Yeah.
And ownership has to make really hard decisions, because they can lease it, but once they start lowering their lease rates, and then how much tenant improvements do they have? The economics are really very challenging. So
free rent, etc. Yeah.
And so we're avoiding those. We're leaning into the newer, better located buildings, and candidly, we're one of the very few that are doing that. And because there is not a pension system in this country that doesn't have a lot of office on, in their portfolios that they're having issues with. And so that will remain an opportunity set for us. It will be a challenge for others. But it's also, look, and I want to say this the right way because I don't want it to sound horrible, but when somebody loses, somebody else is winning, right? And so when somebody hands the keys back on a, big office tower and that trades down, somebody else is going to buy that and they're going to convert it, or they're going to, lease it up at a much different basis. And so we're going to see that. I think 2024, we're going to see a lot more of that than we have before. Again, because reality is setting in, and so anyways, I just want to make sure I'm answering your question.
Absolutely, yeah. Let's talk just for a second. I had just a question on servicing. You're a major servicer. You're a BP buyer at 3650. We've heard a little bit that servicers are, when loans have matured, are not jumping, and the sponsor is not able to, pay the loan off at maturity. They're allowing some extensions for good sponsors that have cash flowing assets and not rushing to foreclose and create a lot of distress. Where do you see how do you see servicers acting this year, both proactive and reactive?
That's a great question. Look, we built our firm around, and we built our stable cash flow lending strategy around the idea that we would finance our ownership of our loans issuing CMBS liabilities. We would issue bonds. Unlike a traditional conduit lender that will originate a loan, sell it into a REMIC, and then the REMIC would engage a master servicer and then sell a B piece to a special servicer. We turn the pooling and servicing agreement kind of on its head. And what I mean by that is, under a normal construct, the master servicer does all the cashiering and then makes all the decisions that are required to be made under the loan documents. If there's a consent required, the master servicer does that. It is not until and unless the loan goes into default that it goes to the special servicer, and then the special servicer gets to charge a lot of fees. They their incentives are slightly different,
right,
because of the ability to charge fees and the like. We said, look, our job is, if you think about what's the best outcome as a lender, it's to make a loan, get it repaid with interest. That's as good as it will get. And so how do you stack the deck in your favor to make it, to achieve that best outcome? You work with your borrowers, and when your borrowers have issues, you attend to those issues, and when a borrower comes to you and has a lease, modification or extension or a reciprocal easement agreement or anything, they're usually coming to you with a value creation proposition. Why wouldn't you pick up the phone immediately and have a meaningful conversation with your borrower?
It's a problem of incentives, right? So you've realigned the incentives.
That's exactly right. So under our pooling and servicing agreement, which has been accepted by everyone at this point, the master servicer does all the cashiering. We do everything else. We're labeled the special servicer, but your loan doesn't have to go into default. We get the phone call about the lease, modification. We make decisions of any decision that's made about the underlying real estate, and the borrower it's made by 3650. So to answer your question, we have the flexibility to work with borrowers, and we're going to do what's right for the underlying loan, which means it's right for the bondholders, which means it's right for us. And it's if that means an extension is necessary, if the economics work, we're absolutely going to lean in and help accomplish that. There's no reason not to.
Got it. We should get going on the wrap up here, but I just have one more question or two for you, and I don't know, Ed, if you want to ask another question. Mine is this: what excites you the most about the next 6 to 12 months, and what is the most worrisome thing that you can kind of see in the next 6 to 12 months, not for the real estate macro market, but more for your opportunity set in particular? Like, you know, you have your 4 or 5 buckets of capital. Like, what are you most excited about with respect to those, and where are your ears perked up?
I would tell you, I'm excited about just the fact that I think we're going to see a lot more opportunity come our way this year, that people are going to transact. And
Yep.
I'm excited about the fact that we're very well capitalized. We have a lot of dry powder to, for those opportunities. And, we're at a stage in our careers where, relationships do matter. And I'm excited that we are receiving those phone calls from, guys like you and saying, hey, we got this situation. How would you look at it? And, what's the best approach? I'm excited about all of that. What worries me is what I talked about a minute ago are the macro, geopolitical, and we have an election year. And we could spend,
that could be its own show.
About that.
It's an election year?
Yeah. So I do worry about, the election in November. I do worry that, I just learned, and I won't mention the city because I don't want to be barred from there, but it's in the city in the Northwest just passed a law where if you're residential tenant, you can't charge more than a $10 late fee, for your multifamily tenant, on their rent. You can't evict during the winter. You can't evict a student. And so it's, these are all great things to protect renters, but it completely, what scares me is the complete loss of the what it means to own and operate real estate. It's not a risk-free enterprise, but all the risk and all the burden is being shoved onto real estate owners and operators. So what worries me are, you've got states like Texas and Florida that don't have all that. So that's why we're seeing the population movements there. That's why we're seeing all the economic activity there. The other side of that is we're seeing great cities in our country just get drained of, intellectual capital, of capital. And, will they come back? Yeah, they will probably, when the world turns, we're starting to see some movement, in areas. But I just worry that we live in an over-regulated environment that is going to make real estate development, ownership, operation even more difficult.
Great. Ed, anything else, buddy, from you?
That's it from me.
Cool.
Thank you, Jonathan, so much for coming on.
Thank you for having me. I enjoyed this. Anytime.
Anytime.
Right. Thank
Good.
you, guys.
Thanks.
All right, gentlemen. All right.
All right.
Bye-bye.
Thanks.
We'll see you.
Bye-bye.